Morning, everyone. This is Barry Knapp with Ironsides Macroeconomics. It's Monday morning, July 19th. This will serve as our weekly audio and video summary of our note this week, which was titled 2H21 Outlook Transition to Mid-Cycle. The video is produced by our friends at Nucleus 195. There's 4 sections to the note this week. We couldn't let last week's inflation shock go by, so that's the subject of the first part of the discussion this week. The second part of the note was the second half policy outlook. We titled it Repeating the 60s Overreach. The third part of the note was the economic outlook, bottlenecks clear, inflation persists. And then we wrapped it up with markets, less liquidity leads to a volatility shock. So first on last week's developments, and there were a number of them on the policy, macro, and corporate side. We had noted that the breadth of the market was narrowing, even though the index was moving to new highs. It looked very much like it did in the beginning of 2020, when not QE, the 60 billion of Treasury bill purchases per month, were driving the index up, but it was driven by, FANG, large cap tech platform companies, but the bulk of stocks were not rising. So we thought the market was acting a bit vulnerable. We spoke about it on Friday morning, on Bloomberg TV, and also spoke about it a little bit on Monday on Fox and Wednesday on CNBC. And we thought the market was vulnerable. So when we woke up this morning and saw the S&P's down 50 points, with it being attributed to the Delta variant, we think that narrative is short-term and temporary. This has far more to do with the liquidity issues that we're going to get into at the end of this discussion. We did clearly have some very negative news on inflation last week. CPI, PPI, and import prices, which doesn't get as much attention, but to us is really where we're going to see inflationary pressures originating from in the decade to come. All of those were considerably stronger than expected. And while Fed officials may very well have intended to look through the second quarter's strong data, this has to have shaken their confidence some in their call that inflation is going to be transitory. It's clearly in the pipeline. It's being imported. It will persist longer than they expected. And the sectors that saw disinflation as a consequence of the pandemic, owner's equivalent rent, housing, and medical care, those are, in the case of housing, is just starting to increase. There's lots of evidence that rent is picking up, and you still see housing has only come back to its prior trend of a little better than 3%, which of course is above the Fed's target. And medical care inflation actually fell in the second quarter. So that's very unlikely to persist. So we're going to wind up with inflation settling at levels higher than the Fed's target, we think, is trend inflation after the bottlenecks clear. We also received information on the policy outlook. The Democrats reached a budget resolution. We'll come back and talk about that in our policy section. We wanted to comment a little bit on bank earnings as well. There was some good news in bank earnings. Obviously, the stocks didn't react particularly well to those earnings. We kind of expected that, but they'll be in buying back their own stock, so we wouldn't be sellers here. Additionally, though, there is pretty good evidence that consumer loan growth is picking up. We think commercial and industrial loan growth will pick up as those bottlenecks clear and inventories are rebuilt in the second half of the year. That should be good news for the organic growth outlook for the bank stocks going forward. But importantly, profitability has returned to pre-pandemic levels. Return on equity is back to 12%. Return on assets are a little lower. We showed that chart in our weekly, just to make the point that all that cash on bank balance sheets from fiscal and monetary stimulus is acting as a little bit of a profitability drag, but still return on equity is back to 12%. That's a level above their cost of capital where they can build capital and then return it to shareholders. So pretty good news from bank earnings for those stocks. And this week will all be about industrials, and then we'll get into the big platform companies the following week. So on the policy front, we do think there's a reasonably good chance they'll taper at the next meeting. The various policy officials have kind of gone to their corners. There's the coastal regional Fed bank presidents led by the New York Fed bank president and San Francisco Fed bank president, who clearly do not want to start the taper process. And then you've got, interestingly, the Dallas Fed president and St. Louis Fed president arguing strenuously that you should be tapering those asset purchases. But the leadership's been very non-committal on this. Those that thought that Powell was going to give away or pre-commit on behalf of the committee at his congressional testimony last week were really not paying attention to how Chair Powell has conducted his business. He was very non-committal. We haven't heard from Clarida. We haven't heard from Brainerd. So it's still possible that they could decide to start the taper process at the next meeting, which is a week from Wednesday. On the fiscal side, though, the Democrats, as I mentioned, reached the $3.5 trillion budget agreement. This is likely to push government spending to 25% of GDP. Our regular readers will recall we've talked about something known as Hauser's Law, which is really an empirical observation that we've never been able to collect much more than 18% of GDP, regardless of what the tax structure looks like. So this idea that it'll be paid for, that being the spending will be paid for, is a bit dubious. We're going to seemingly run, if the Democrats go through and spend this much money, with intractable budget deficits and the debt on a pretty steady rise through the course of the next decade. That is the 60s overreach idea. However, on a little bit more positive note, on this human infrastructure expansion of healthcare spending, we would note that it seems very unlikely that there's going to be a Medicare buy-in or public option for Obamacare, in which case the worst case scenario for us was taken off the table for healthcare and healthcare insurers. So with this note, we upgraded the healthcare sector. We had wanted to be long it through the business cycle. We do think technology innovation, adoption, and the delivery of healthcare services, even some of the technology innovation in the pharma biotech area, is going to be a real secular trend for the healthcare sector in the 2020s, and we want to be long that sector. So we're upgrading it as a consequence of getting the details of this infrastructure spending and the worst case scenarios not on the table. Moving on to the economy, we think the second half is going to be very robust. The bottlenecks are going to clear. Capital investment's going to pick up. This is very good news for productivity. We're going to have stronger labor productivity this cycle. The work from home concept is going to improve labor productivity. Capital deepening will improve the productivity of our capital base, and innovation adoption, we think, is going to be a real theme in sectors like healthcare and industrials, the financial sector, and of course, it's already been going on in the consumer sector. So we'll have strong productivity from all of the three primary sources, and that'll be increasingly evident in the second half of the year. That's good news for wage growth. It means that the steady wage growth we've been seeing since the beginning of 2018 will persist. It won't be wildly inflationary at the beginning. We think this is a reflationary environment, not an inflationary environment. That's very good news for profit margins on a go-forward basis. And we think resi investment will start to improve in the second half as well, residential investment, that is, because some of these bottlenecks will clear and prices will stabilize to an extent. Underlying demand is likely to be very strong. Finally, on markets, we think we're going to get a liquidity shock. We may have already started it. The Treasury general account process of draining that liquidity, which is a direct injection into the economy, it's been $1 trillion or so far, is almost complete. So that will mark an inflection point where we're not getting quite the liquidity injection from the Treasury draining their account at the Fed and dumping it into deposits at banks and individuals' checks. The last checks went out last week as a note, the child care benefit. QE, we think the Fed is set to start slowing that process. And then the current account, the recovery in global trade and manufacturing, which has been recycled back into US dollar treasuries. We think that's close to an inflection point as well. Global trade is going to slow again as those bottlenecks clear. So we think we're going to get a pretty good risk-off event. Our full-paid subscribers got a couple of pretty cool tables which showed what risk-off events look like when you get these Fed policy normalization related corrections. In 94 and 04, the market tipped its hand a little bit. The sectors that wound up being the best performers through the cycle, in 94, that was tech. In 04, it was financials and energy, did outperform during those risk-off events. The risk-off events in the 2010s were much more highly correlated markdowns of all of the sectors based upon their beta or relative volatility. And you didn't get as much information about what was likely to be the big winner through those cycles. They were bigger. We've talked about this in part because of the role of volatility suppression through the Fed purchases of mortgages and suppressing that mortgage prepayment risk, which used to sit with the private sector. So we do think that correction's coming. Again, though, remember, those are some of your best windows of opportunity to add capital to the market for the business cycle to come. Somehow we heard a narrative a fair bit last week that the Fed traditionally causes these recessions. That may have been true in the days of Milton Friedman, but the last couple of recessions have been caused by asset bubbles and the Fed not tightening enough and and waiting too long to normalize policy and letting asset bubbles develop. Those asset bubbles, to really cause serious recessions, need to have debt associated with them. So this isn't a call, hey, stocks are expensive, the market's going to crash, and we're going to have another recession. That's not what we're trying to say. In fact, we're trying to say that when we have this risk-off event, when the Fed tries to normalize policy, that'll create a buying opportunity. But if you were all in long ahead of it, you may want to cut some risk. And we've been suggesting, although we like the reflation theme, which in equity sectors means being long energy, materials, financials, industrials, we downgraded materials a month or so ago. We think you should be market weight there. We like being overweight the other reflationary sectors, but we think you should be raising cash, have 10 to 20% cash at hand, depending on your risk tolerance, so that you can take advantage of this risk-off shock that we think is coming. And again, we're upgrading the healthcare sector, so we suggest being overweight there, market weight tech, telecommunication services, and underweight the other defensive sectors. So that's it for me this week. Barry Knapp, Ironsides Macro. If you're not already a subscriber, please consider becoming one. You can read the whole second half outlook note with all the tables, charts, and graphs. So have a good week, everyone.